All right, everybody. So welcome to Building Wealth Through U.S. Real Estate. Just before we start off, I always start with a disclaimer that basically the event, we're here just to educate people, and we want you to get your own advice, your own legal advice, or your own accounting advice. But just today is just gonna briefly talk a little bit on some stuff that I suggest you getting a professional opinion on. So a little bit about me, if people don't know me. My name is 𝘾𝙖𝙣𝙖𝙙𝙞𝙖𝙀🙬. I'm a full-time real estate investor. I'm the managing partner of 𝘏𝑑a Partners and the founder of 𝘏𝑑a Capital. It's a real estate investment fund that we're actually launching in the next couple weeks. So essentially why I started this group, getting into US real estate, it's a little bit hard, to find the proper information. And it's actually hard to find somebody that understands the tax side of things on the Canadian side or on the American side. And that's why I like to share the information I've come across through doing all my research and being active in US real estate. Today, I just want to promote discussion, use the Zoom chat, and feel free to ask questions. We kind of want to make this kind of like a town hall style presentation for the first time. So please have your mic turned off, but feel free to ask questions in the chat, and I'll monitor the chat. And if not, if you didn't answer the question, we'll do it at the end of the presentation. So again, welcome to navigating the U.S. tax system. So we've got Elliott Milek. I actually met Elliott maybe 4 or 5 years ago through events that I was running in-person events in Ottawa. And then we became friends. And just as recently, we became business partners. But Elliott's been giving me lots of good advice on investing in the U.S. And I think that's something that as Canadians, we kind of don't do right at the beginning when we first get into US investing, our first property or second property. And that's part of the reason why I wanted to put this webinar, just to kind of educate people on investing in US real estate, just because I have some legacy projects that originally I wasn't too sure if I was going to like investing in the US. So I didn't really put that much thought in my tax structure and so forth. And 5, 6 years later, I'm still paying the price in double taxation. And I just don't want people to make the same mistakes that I did. If I would have spent a couple $1,000 up front, I would have made a lot more money.
Bit of a background on myself. So I was born and raised here in Ottawa. I grew up kind of reading all the Rich Dad books and learning about real estate and how to invest and doing all that good stuff. Back in the day when I first started, I started buying out in the city of New York. I bought probably 10 years ago, pretty much fresh out of university here at Carleton, and I was buying kind of duplexes, triplexes in Syracuse, New York. I honestly, I'll probably look at every single city in the United States when I first started out, but I kind of settled on upstate New York, primarily one for the cash flow purposes, and two for the proximity. I really had very, very little experience in the real estate market 10 years ago when I first started this business. And I kind of just wanted a location where I can drive to that is fairly, I can drive there and back essentially, essentially in one day. So at the time, I really, while I was working fresh out of university, I was working at Ernst & Young at the time. I was working in the U.S. tax department there. So even though, I was working in the U.S. tax department, obviously I didn't know much at that time. So I set up, different corporations to hold some of these properties. I mean, the laws have changed pretty significantly at the time, but, I similar to Matt, I didn't really get the tax advice I needed to set up these entities properly, essentially. Even though I had my partners and my bosses who I could have leveraged off of and just asked them basic questions. So there is always that fear factor when you're kind of first starting on this business that you really need to put the things in place right away, essentially. So to give you a bit of background on myself, I worked at Ernst & Young for 8 years. That's kind of where I learned, the different org charts, different structuring for, buying U.S. real estate for Canadians. After 8 years at Ernst & Young, I went down to Deloitte for about 2 years. I worked as a manager again in their U.S. tax department. And then after that, I kind of branched out on my own. So I started up my own practice about 4 or 5 years ago, kind of specializing in working with Canadians that buy U.S. real estate. I mean, I do have a lot of clients on the U.S. side that buy Canadian real estate. I do have a lot of other type of cross-border type issues. Canadian businesses that sell to the United States. I have a lot of investors or Canadians that are U.S. citizens residing here in Canada, so they still have to file a U.S. tax return. So end of the day, I mean, I've always been kind of involved in real estate in some aspect. I've never bought a rental property here in Canada, but I've bought a number in the United States. I've been selling off those New York properties because I am looking to kind of buy further south and obviously invest with my team in Philadelphia as well. So, but like I said, for the past 4 or 5 years, I've been working with a lot of Canadians that buy U.S. real estate, and that's kind of where we're at right now. So kind of high level. Typically, when I first start off these presentations, what I like to do is kind of discuss about some of the recent, or at least the proposed changes that are going to be affecting us as Canadians buying real estate. Obviously, as you're aware, there's a new administration, there's a new Congress and Senate as well. So considering we're in a COVID environment, there may be some changes to some of the pre rules that Biden wants to impose. So he's talked about, hasn't passed through the Senate or the Congress yet, but he does want to increase corporate tax rates by 7%. Under the Trump 4 years, there was a significant decrease in the corporate tax rate in the United States. So it made it a lot more advantageous for Canadians to buy. Typically I don't recommend through a corporation, but there is an option to do that. And that will be changing if you do own corporations in the United States. So I have a lot of clients that own real estate in the personal name in the United States. So there is a talk about potentially increasing the capital gains rate in the United States. So as typically a long-term rate is about 15% on if you sell a property in the United States, that might be going up if you're a high income earner. So if you make more than $1 million, that long-term rate might go up to 20% or 25 or even 30, depending. Again, these are all speculation at the moment, but it is something to keep in mind on kind of how you own your property. So the biggest one, especially with respect to our older clients, is again the federal estate tax. Essentially, if you own U.S. property, you are subject to U.S. estate tax on those U.S. assets. Trump increased the rates from about $5.4 million exemption to 11.7. There is a lot of talk to bringing that back down to 5.4 and possibly even 2.5 or even $3 million. So if you do own a sizable portfolio in the United States, and you do pass away, that exemption can be pretty significant for you. I don't want to talk too much about 1031, but because they really typically don't apply for us here in Canada. But at the end of the day, there is going to be possibly some limitations on being able to utilize it if you are a U.S. resident, because I know there are a few people in the United States on this call. So currently, if you do make over $400,000, that 1031 exchange may be limited to you essentially. So. Okay, so Matt, is there any questions on the chat?
Oh, we're good.
Okay, perfect. Okay, so I'm just going to talk about different ways that you can kind of buy U.S. real estate. Typically when people are first starting out, they typically buy it through their individual name. There are benefits and and disadvantages to that type of structure. One is obviously you own assets in the United States in your personal name, and if there's a lawsuit, in theory, your tenant or a contractor can essentially sue you for your personal assets. So there's liability risk, and one of the main reasons, 95% of the world's lawsuits do happen in the United States. So if you are looking to buy in the personal name, you do need to get sufficient insurance and make sure you talk to your legal representative properly. But one of the benefits with buying in your personal name is that you do get the benefit from the lower marginal, federal and income tax rates as opposed to through corporate rates. So currently, the corporate rates in the United States are about 21%, probably going up to 28%. In the United States, if you make less than 50,000 or 100,000, you're probably paying somewhere around 20% or so individual tax rates, or even less. So if you do buy in your personal name, I should say, you do get that benefit of a lower tax rate, essentially. There are disadvantages. Like I said previously, your U.S. assets will be subject to U.S. estate tax. So there will be some changes coming up over the next 6 months, probably 12 months with respect to that. So depending on the size of your portfolio in the United States, that may impact your decision making. There are FERPT issues as well. So really just kind of withholding. So anytime an individual who's not a U.S. citizen that sells property in the United States, there is a kind of a withholding that the IRS does. One of the biggest disadvantages with respect to that is that it typically takes about 6 to 12 months before you get that refund back. So there is kind of a time lag by the time you sell your property and you kind of receive the funds or all the remaining funds from the IRS. So one of the benefits we talked about kind of financing earlier. So one of the benefits with buying in your personal name is that is a financing aspect for Canadians essentially. A lot of the banks, RBC, TD, they will to lend to Canadians on U.S. property, but it cannot be through a U.S. entity. Typically, they require you to buy it in your personal name as they use your personal credit score. You can't buy commercial property, but you can buy 4 units or less. So it is kind of an easier way to get financing in the United States through a Canadian bank. But again, you'd have to buy it in your personal name, and there are liability risks with respect to that. So.
And you got to watch it too. Some Canadian banks will only lend in specific markets. So it's not the whole United States that they'll lend at 80% loan to value. So you got to watch the market and have a conversation before you get into it. Absolutely.
You really just going to need to call your banker and just to see what their options are. The terms are okay. Typically, you're looking about 20-25% down, depending on the bank, and the rates are fairly realistic or reasonable compared to what people in the United States are getting. But again, some banks won't just lend on any city or any specific property, essentially. So there are pretty specific parameters. So. Okay, so that's kind of the first way. And to be honest, this is typically how, like I said, how most people kind of get started. Biggest thing is it is the cheapest way to do it because you don't have to set up a corporation, you don't have to set up a partnership or a trust or whatever the case may be. So you do save on those incorporation costs, and there's less tax filings at the end of the year as well. So typically, if you're only buying 1 or 2 properties, a lot of people kind of buy in their personal name, and then down the line, once they have a few more properties under their belt, they kind of quick claim deed that property to some type of entity that we set up. So, so Canadian corporation is another option. There are people that have operating companies or have holding companies with significant cash in them from their existing businesses. So you are allowed to buy U.S. property through it. That Canadian corporation that owns the property will have to file a U.S. tax return and a state return depending on the state you're in. One of the benefits with respect to this type of vehicle is that you do get to claim a foreign tax credit. So any taxes you pay on the U.S. side gets credited here in Canada, so you're not going to be double taxed on those. The biggest concern with respect to this is that the way CRA taxes passive income through Canadian corporations. Essentially, CRA considers any type of passive income to be taxed at about 50%. So you're paying about 50% in taxes by buying, some type of passive income, whether it's a real estate or royalty or some type of bond. So you're paying about 50% in taxes through a Canadian corporation. Here in Canada, if you make more than $200,000 a year, you're already in the highest marginal tax bracket anyways, and you're probably paying more than 50% depending on the province you live in. But if you do, pay or make less than that amount through your personal name, Canadian corporation might not be the best route to take. One of the benefits with respect to this type of entity is that you're actually not subject to the estate tax. So the shares, since you own the shares of a Canadian corporation, those shares are actually not subject to it. So maybe some tax planning opportunities if you're looking to retire. Depending on where you are in life, essentially. So the third way is a U.S. corporation. I do have a few clients that buy through some type of U.S. corp, whether it's a C-Corp or whatever the case may be. Again, the biggest reason we want to do that is more for liability risk, obviously separating your business assets from your personal assets. The U.S. shares, unfortunately, are subject to the U.S. estate rules. So if you do pass away, that will have to be brought into. And if you do have if you're above that exemption amount we talked about, you will be subject to U.S. estate tax on it. Again, one of the biggest downsides with holding through a U.S. corporation is, the U.S. corporate rate is going to be going up by about 7%, likely either this year or possibly next year. So you will be paying about 27% federal tax, and then somewhere between 5 and 9% state tax. And then ultimately, when you do kind of take the funds out, you have to pay tax again here in Canada on that amount, but you do not get to claim a foreign tax credit on that, on the original tax you paid in the U.S. So it's not the most tax-friendly situation, but I do have some clients that have that. I mean, primarily because they want to keep the funds in the United States. So there is some benefit there because you get to defer the personal tax until a later date. Maybe they want to transfer or sell the shares to their kids if they're getting older. So there are some tax planning opportunities there, but typically a U.S. corp is not the most tax advantageous way of holding U.S. real estate as a Canadian, or to be honest, even as a U.S. individual as well. So.
See, there's a lot of questions being asked. I'm just writing them down, and we'll answer them at the end. But we'll answer them, guys.
Very good. Yeah, no, I know I'm going kind of fast, but by all means. Okay. So, I'm sorry. So typically for most of my clients, what I recommend and what I've spoken to a lot of cross-border tax accountants, typically the best way to own U.S. real estate as a Canadian is through some type of flow-through entity. 5-6 years ago, we can use like what sounds like a triple LP in the United States, or even a double LP. To be honest, even an LLC was working 5-6 years ago, because CRA actually considered them to be a flow-through entity, similar to the way the IRS treats these types of vehicles. The rules changed 5-6 years ago, basically saying that those types of vehicles are no longer eligible, mainly because they don't have a general partner in those types of partnerships, essentially. So CRA considers those types of entities as foreign corporations, as opposed to a flow-through entity. So now you essentially have an LLC in the United States that is taxed as a corporation here in Canada, but it's taxed in the United States as a flow-through entity. So you're kind of getting double tax without the benefit of a foreign tax credit, essentially. So you're kind of getting double tax with those types of entities, which kind of leaves us to essentially this one type of entity, the U.S. limited partnership. And the main reason for that is that CRA's come out and confirmed that because the U.S. LP has what's known as a general partner as one of the two partners or multiple partners, they consider it to be an actual partnership and an actual flow-through entity for both U.S. and Canadian tax purposes. And because we can use those flow-through attributes, essentially eliminates that double taxation situation, because now we can claim what's known as a foreign tax credit. Okay, but 90% of my clients uses some type of vehicle such as this to buy U.S. real estate, whether it's a small residential property, whether it's a large commercial property. And end of the day, the tax situation works the same regardless of what type of property you're buying. So this is kind of an example of kind of how, for example, if one person just wanted to buy, I don't know, like a 4-unit building, kind of how we'd set them up essentially. We'd set up a USLP. Say you want to buy in Ohio, you buy that 4-unit in Ohio down here through this USLP. Okay, we set up a second corporation, because in a partnership you need to have at least 2 partners, right? Set up this second dummy corporation to be the general partner, and then you're up here as a Canadian individual owns 99%. Okay, so because this is considered a flow-through entity, this LP at the bottom, all the income flows up directly to this individual and to this corporation. So this LP does not pay tax, which eliminates that double taxation situation where a company would occur essentially, or would have to deal with. Okay, so this individual up here would file a U.S. tax return first, because it's a U.S. source income. So you file a U.S. tax return, you pay U.S. taxes on that income first, and because you're a Canadian resident, you have to report that income again on your Canadian tax return, but any taxes paid on the U.S. side gets credited here in Canada. So you're not going to be double taxed, and that's where that foreign tax credit is key for us as Canadians, essentially. And unfortunately, this is kind of one of the few entity structures that we're actually allowed to use here in Canada to claim that foreign tax credit to kind of minimize or at least eliminate that the double taxation that would exist. So anyways, I think I just talked about this. It's really just high level. The USLP kind of limits the double taxation again because we're allowed to claim that foreign tax credit when you file a tax return as an individual. The tax treatment changed about 5-6 years ago for LLCs, double LPs, triple LPs, because there's no general partner in these types of corporate or entities. CRA does not consider them to be what's known as a flow-through entity. So now they're taxed as a corporation, which is subject to double taxation. Again, the LP number 3 is essentially you do get the benefit. So if you do make less than $200,000 here in Canada, you do with the LP structure, you do benefit from paying individual taxes, paying corporate tax, which is typically lower, especially on the capital gains side. You pay about 15% capital gains, individually in the United States, as opposed to 21% or eventually 28%, in 6 months when the rules change. So you do benefit in that aspect as well. And then I've spoken to a lot of, again, I'm not a lawyer, but I have spoken to a lot of lawyers on this situation that they do indicate that the LP structure does provide a lot of liability protection. Again, you would have to speak to your attorney on this aspect, but it would separate out your business assets in the United States from whatever assets you might have here in Canada. So, okay. So that's kind of the 4 or 5 ways that most people typically buy U.S. real estate. I mean, there are other options. I mean, I have people that don't have put property in trust. Sometimes they have a Canadian trust. They just want to buy a vacation property, in Florida or New York or to ski or whatever the case may be. So there are various options. Again, everybody's situation is going to be a little bit different. The biggest thing is it's really just figuring out your situation, the types of properties you're looking to buy, and making sure that the structure we put in place for you kind of aligns with your ultimate goals, essentially. So, all right, Matt, do you want to take a few questions quickly, or do you want to?
Yeah. So stop sharing your screen if you don't mind, there, Elliot.
Yep.
1 second here. I'm just trying to catch up on all the questions here. All right. So let's start with the first question here, Elliot. So this one's from Peter. Can Canadians utilize a 1031 exchange?
So great question. And in theory, typically, no. I mean, so I should say in theory, yes, you can do it on the US side, but for as Canadian, typically doesn't make any sense to do it. The main reason for that is, on the US side, you would sell a property, you would defer the gain on the US side. Here in Canada, we have what's known as the FAPI rules, the foreign accrual passive income rules. It basically states that you as a Canadian, whether you're a Canadian individual or a Canadian corporation that owns a business or a company in the United States that owns primarily passive type income, essentially you have to be taxed in Canada as if you own those assets in your own personal hands, right? So even though you get to defer that gain in the United States, you personally would have to report that gain here in Canada. So you still have to pay tax in Canada. And because we have higher tax rates here in Canada, it doesn't make sense to kind of defer the US tax essentially. So in theory, yes, you can do 1031 from a business, unless Canada reduces their tax rate significantly over the next couple of years, which I don't see happening. A lot of times it just doesn't make any sense to do it. So.
And there's different, when you get a little bit more sophisticated too, there's kind of, we're calling them kind of like blockers too in the US to kind of help you scale that. But it looks like the 1031s are going to be, it looks like that new administration is probably going to take them out. So it'll be a little bit harder to get them going anyways. And also 1031 exchange, if you read the terms too, you have to own the property essentially for 365 days. So if you're doing a flip or anything like that, you don't qualify for 1031 exchange. We use other tax strategies too in the US. There's one, it's called an opportunity zone. So if you hold essentially the property for a 10-year span and you dispose of it in 10 years and it's a qualified opportunity zone and you have $1 million profit, you're not taxed on the federal level in the United States. So it's a little bit more complex. I can get into details on another call, but that's a great way too. And even on the municipal levels, some municipal levels too, they give you what they call tax abatement credits, so that we'll use for advantage too with the proper structure. So let's say you buy a piece of land for 100,000, your property tax are, let's say $1,400 a year. You put a building on it, they're only going to tax you on the land value, not on the building. So those are different strategies too that you can use depending on the city you're investing in the US. So there's many opportunities there. So the next question is from GP. If I'm not too sure what LVR, if your loan to value, sorry, if your LVR is over 45%, getting a mortgage for US will be on top. So I'm not too sure about that question, what you want the answer on that one, if you can.
Go ahead.
Well, I was just saying, if the banks have already qualified you and said, you know what, you're pretty stretched within Canada. So will they consider US as a different setup, or will they put that in another 45% criteria to qualify you?
I think it might be a little difficult to get a loan in that aspect from a Canadian bank, but I mean, if you're looking for commercial lending, your FICO score shouldn't be an issue, right? And if you are looking for commercial lending, then you will have to go to a U.S. bank anyways. So so to be honest, I mean, Matt's probably better on the lending aspects than I am, but at the end of the day, if you're looking to buy commercial property, your FICO score probably wouldn't. Your FICO score or your ability to, your ability essentially, or your current loans shouldn't impact you essentially.
So another way too, you want to get, I always make a mistake when I say is it your EIN number? What is it again, Elliot? I'm forgetting something.
At the company number you're asking for? Or?
Yeah, your EIN number to help you.
Yeah.
So that helps you with your credit too. So you kind of have to, we're using that now to start creating credit in the US. We have partners we're pretty lucky with the way we do business. We have partners that co-sign on the loans for us. So that's part of our deal. We also have other people that will co-sign for us on the loan. So you have the better terms, and they'll usually charge us 1 to 2% of the total loan amount. So that's a good way to get high net worth individual to work with that they're making a bit of money using their credit. So there's different ways, but as a Canadian, 100%, it's hard to get some type of financing because we're in a different jurisdiction. I've seen some banks go as low as 50% on the value, but then the numbers don't work. You pay a higher interest rate. But I always encourage people to try to find yourself a boots on the ground partner to help do that. All right, next question, Irina. Is there a limit on how many properties they can lend? So it's a Canadian bank, so usually RBC Desjardins will do that. To be frank with you, I just started a conversation with them because we're looking to expand in a different market eventually. From what I understand, I think RBC will go up to 4 properties in the US. But the terms will change after the first one. So I would recommend you talking to an RBC rep, but supposedly they're the easiest one to have multiple properties, especially in Florida. They like to lend in Florida. So Frederick asked, can you please give us an example from your experience which US markets Canadians banks will or will not lend towards? So it's a case by case, bank by bank, but primarily the Canadian banks want to lend to Canadians as a primary residence. So if you want to do kind of like a short-term rental in that, you got to just make sure that you're allowed to do it. But what you want to be really careful about is making sure you're doing it as a secondary residence. That's how a lot for the first one to do that the banks are going to lend on. Tarun, I hope I said your name properly. What is your comment or scenario where a Canadian citizen partners with a U.S. citizen to buy a property in Florida? This is going to be an individual name, and U.S. citizen is going to apply for a mortgage, but ownership title will be both partners. will a Canadian citizen write off the expenses and the taxes in the US?
So, if the Canadian individual is a beneficial owner of the rental income, then yes. So in theory, I mean, a lot of people get kind of hung up on who actually is on title. That's more of a legal thing than a tax thing. What CRA and the IRS are more concerned about is that who actually gets the money, right? And that's kind of key, because that's who pays the tax essentially. So if you're receiving 50% of the rental income, then you are eligible to claim 50% of the expenses pertaining to that property, both on the US side and here in Canada. So.
Thank you, Elliot.
You're welcome.
So Ida's asking, what if you already have an LLC? How do you eliminate the double taxation?
So we'd have to probably figure out what's in the LLC. There's really nothing there. We kind of have two options. One, we can either dissolve it and create something new, or two, we can do what's known as an entity classification. So we are allowed to reclassify some of these entities depending on the state that's incorporated and what you're looking to do essentially. But a lot of times, even if you do have an LLC, remember, we do need two partners in a partnership type structure. So that LLC can essentially be the 1% general partner, and then you personally can just create an LP to be the 99% partner. So there are ways around getting it, and I get this quite a bit, especially if you're dealing with kind of an American accountant. You know, they're cookie cutter type advice, just typically put in an LLC. And as a U.S. individual, you know, it's a great avenue, but here in Canada, it just doesn't really work for us. But yeah, there are options for you to change that. So
JP asked this question: do Canadian banks only give loans on a basis of a T4? What if you have an operating company here? So that's a good question. You'd have to talk to the lender, to the lender for that one. We don't utilize that in our strategies, just because we get better terms in the US. They're a lot better than in Canada. Usually we can negotiate our loans, versus in Canada there's not much negotiation left. But I would encourage you, if you're trying to do that on the Canadian side with the Canadian bank, I would not talk to somebody on the junior level. I would talk to someone that has a lot more experience in lending through to the US.
So I'm actually dealing with something similar right now. One of my clients in London, they're looking to buy a new house essentially. They have been fairly successful. They do assignments and they flip property here in Canada. You know, they do it on a seven-figure level. The difference is that for the past few years, they only took out about $25,000 from their business. So they only reported about $25,000 each year on their individual return. So that was kind of the issue with respect to getting lending. So they did, even though, you know, they're making, you know, 6 and 7 figures through their businesses, they're only reporting, you know, a very, very minimal amount on their personal returns. So the mortgage lender they were using was primarily looking at their individual returns. So essentially, you know, there was some tax planning opportunities where we did take out a dividend, you know, for 2020 and 2021 to basically include into their personal returns. So, you know, so to answer your question, T4 is not the only income they look at. If you do have a business, certainly if you take out money out through a dividend, that's additional income that most lenders will look at. But again, you'll have to talk to your mortgage broker to get exact details. So,
thanks, Elliot. Thanks, Matthew.
So PS is asking, can you talk about a C-Corp? Is it beneficial for Canadians?
So I guess it depends on the goals of the individual. So currently, you know, if you buy a property, let's say, for example, in New York, you're paying about 21% tax on $1,000 of yearly profit. So you're paying 21% automatically. Then in New York, you're probably paying about another 9%. So you're paying about 30% tax right off the bat, you know, through a C-Corp, right? So it's not a huge issue unless you plan on using those funds to kind of finance your personal expenses. So if you keep those funds in the US, then you're basically just paying 30% every year on the profit. You know, if your plan is to take those funds out of the business, then every year, essentially the US has what's known as like a 5% withholding obligation. Since you're a Canadian, there's no personal tax being paid, you know, individually. So basically they impose this 5% withholding, you know, when you issue a dividend up to a non-resident, to a Canadian. So now you're up from 30% up to 35. And then you're essentially paying probably another, you know, depending on how much money you make here in Canada, probably another 15 to 20% taxes on your Canadian side without the benefit of a foreign tax credit. So So ultimately, you're paying about 50 to 55% in taxes through a C-Corp. So it's not the most advantageous way of holding U.S. rental property, but it can work if your long-term goals is to keep the funds in the U.S. If you're looking to migrate, because I have a lot of clients that are looking to move to the U.S. So this option may work for you, but if you're looking to take funds out of the business every year, probably a C-Corp is probably not your best option. But again, it's going to be dependent on your income level here in Canada, essentially. So.
All right. 1 second here. Chandra's asking, what financing option may be available for Canadians who have not shown any T4 income in a couple of years, but has asset? This is to buy a U.S. property.
I don't know. I mean, if it's a commercial loan, then they're going to base that loan off the asset as opposed to you, right? So, if you're not showing a lot of income personally, then your best option would be to to find a property that's 5 units or above that could be lent commercially, essentially. So,
or even some private lenders. We use a mixture of bank financing and private lending, depending on the project and how quick we want to move on a project. So maybe a private lender at the beginning, it's a little bit more expensive, but just to create the momentum, create that track record, that can be an option too. But it's you got to be creative as a Canadian. Okay, so Chandra's just send me a message. It's for rental properties. So yeah, as long as the rental property qualifies on its own, like Elliot said, 5 units or up, generally speaking, you might need it's most likely at the beginning to be like a recourse loan, depending on the bank. The majority of the banks right now in the US, because due to COVID, they're now going back to a lot of recourse loan clauses. So it might be a little bit harder to do a deal like that, unless you find a high net worth individual and get him to co-sign for you and give him a 1 to 2% for his trouble. And that's kind of what we've done on a couple of things. So Ryan's got a question right here. If you have a US LP and a LLC as a general partner, does it matter if the property is owned by the LLC or the LP?
So in theory, it should be the LP that owns the property, because they're the ones claiming the rental income and expenses. Yeah, I mean, I don't know why a lawyer or why would you buy it through the LLC? Because at the end of the day, the GP, the general partner, that 1% we talk about, in theory, they hold no assets, right? Because they're the ones taking all the liability risk in the event of a future audit or or lawsuit, or the case may be. So you kind of want to keep the LLC with very little assets as possible. You might want to consider doing what's known as a quitclaim deed, where basically you quitclaim deed the property from the LLC to the LP, and then now the LP would essentially own the asset. So.
Hope that answers the question there for you, Ryan. Frederick asks, do LPs in the US also get an EIN after the setup?
Yeah, so in EIN, it's an employer identification number. So essentially, any type of entity in the US needs it, even if it's a Canadian corporation, that has a filing obligation in the United States, they need to get EIN. It basically distinguishes that type of company with the IRS. And in order to file a US tax return or open up US bank accounts, you will need an EIN. So yes, the LP will need one. So.
Sandra's asking, how is a structured partnership set up when investing with Mada partners? So we can take this offline. There's many options that we do. You can be a passive, you can be an active investor, and we're coming out with a new product that'll be an investment fund too. So it really depends on how you want to be involved with us. So if you want, I can send you an email later and reach out to you on that one. Peter is asking, for rental properties, how do you utilize the depreciation for tax purposes in the LP setting?
So yeah, so any type of real property is eligible for depreciation. So the LP would basically file what's known as a 1065 return every year. It's an informational return, so it's not actually a tax return, but you'll indicate the assets that LP owns, and you claim depreciation. In the United States, it's basically 27.5 years, straight line depreciation over 27.5 years. So essentially, you kind of report all the income that way. But yes, you are eligible to claim depreciation through the LP. So.
Although, what are the different states that most of your clients set up their LPs, and why these particular states?
So typically I always kind of recommend, setting up the LP in the state you're going to be doing business in. If you are looking to invest in multiple jurisdictions, then, they're typically the generic states that you typically hear, like Delaware, Wyoming, Nevada. These three states are typically more, I wouldn't say tax advantageous, but essentially it's more beneficial from a legal perspective. Essentially, these three states don't really regulate having foreign ownership. So essentially, you can be a Canadian or be a resident of another country or another state and still own this company and work for this company and essentially do business for this company while you're outside of Delaware or outside of Wyoming. So that's typically where most lawyers prefer to incorporate. But typically, I don't recommend. But typically those three states are probably more beneficial. But from a tax perspective, it doesn't really matter because where you buy the property is where you're going to pay state taxes. But from a legal perspective, it's a little bit easier to do business in those states as a Canadian. So. And
when you're first starting out too, the more layers of accounting you create, the more your cost of doing business in the U.S. is. So at the beginning, I suggest people maybe not do it because at the end of the day, there's no real financial difference. Because you're actually adding more work for your accountant to file, let's say, in the state that you're doing business and the other state that you're registered. So the more layers, if you have a big machine, it makes sense. But when you first start off, as long as you have the proper structure and the proper insurance, I personally don't recommend you doing that extra layer at the beginning. I don't know if you agree on that one, Elliot, but.
Well, the thing is, when you talk to lawyers, you talk to accountants, and you talk to investors, you kind of get three different answers, right? Like I take the approach because I'm a real estate investor. At the end of the day, I want to see my clients making money. And, and if you're buying one property, if your plan is to buy one residential property in the next 12 months, setting up this massive entity structure that's going to cost you, 5-10 grand, depending on which lawyer you use, is going to eat up all your cash flow for the next couple of years. So it just, from a business perspective and an investment perspective, it just doesn't make any sense. So that's kind of why I say, a lot of my, that's one of the first questions I ask when I speak to people is kind of what's your long-term goals? Like, you're looking to buy a 10-unit building right off the bat? Are you looking to buy one property for the next, one property a year for the next 10 years? Because it's going to change the type of structuring we do to make sure your properties are properly cash flowing and can, and eventually can kind of maintain those additional tax fees at a later date. If you have $1 million in the bank and you're looking to buy a 100-unit building, then yeah, you're going to be setting something up. We're going to have to figure that out. But one residential property, all these incorporation fees are going to kind of eat up your cash flow right away. So, I kind of put the investment perspective first and foremost for my clients, because at the end of the day, you don't want to get frustrated with all these additional fees that you have to pay, and then you're basically all your cash flow is going to be gone for the entire year with all these administrative costs. So.
And especially if you want to use it as a personal residence, and if you're going to put it on the Airbnb or short-term rental, then it makes sense. But if you're only going to use it for personal pleasure, it's Elliot's right. It just eats up and own the property, the extra layers of accounting. JP is asking, is there a lender who could help Canadians with their first U.S. real estate purchase with no fiscal score or social security number? So at the end of the day, if you're looking to do a deal in the U.S. and you want to use a Canadian bank, try RBC and Desjardins. They're the two easier ones to work with if you're just looking for like a less than 4 units. If not, you can send me a message and I can connect you with some Canadians that are using the lenders. I'm not structured to do that at all. I use just my partners in the US to do it. It just saves me time and energy just to have a partner take care of all that for me on the US side of things.
Yeah, just like depending on what bank you use, TD, RBC, and BMO are probably 3 best options to go through as a Canadian looking to buy in the US. You want to indicate that you're buying it for whatever the case may be. You're gonna have to buy something at least $100,000, because there's typically about a $75,000 minimum loan that they will lend to. But yeah, just speak to your local representative at your branch. Ideally, as Matt said earlier, somebody who's maybe a little more higher up than the junior, who is kind of specialized in this sort of thing. But yeah, they'll use they'll use your FICO score here in Canada if you have one. If you don't, then you might want to, again, like Matt said, partner up with somebody locally. So
AJ's asking, sorry, hold on a second. Elijah, with the new governments in the US, should we expect any changes in the tax laws that doesn't really support the current best structure for Canadian investing in the US? Are there any changes in the horizon for the US that we're aware of? You know, the taxes, it's coming. The new administration, we know taxes are going to go up a little bit higher. I've asked that question to my partners that are doing, you know, the everyday real estate activities in the US. For now, they're saying with the coronavirus, with a lot of the infighting in the government, they don't think anything's really going to happen for the next year and a half, 2 years. But it is going to definitely, it's coming. It's a matter of time before it happens. But the way to look at that too as a Canadian is that, you know, in the US too, on the write-offs of property depreciation, you get still a lot more benefits doing it in the US than you do doing it in Canada, I think. I don't know what you want to add to that, Elliot, but
I think we had a question like this, like we're you know, the other day, like, where do you want to buy? Do you want to buy in Canada as a US, or do you want to buy in the United States as a Canadian? You know, at the end of the day, the exchange rate hurts because we are currently at about a 20% differential. But at the end of the day, you know, where are you going to find cap rates of 7-10%, you know, in Canada, right? Unless you're going to some small tiny little town that people are leaving, you know, you're not going to find that type of cash flow. So end of the day, you know, the tax situation, you know, it is what it is. End of the day, as a Canadian resident, you're still going to pay taxes based on the Canadian rules because you live here in Canada. But you're going to cash flow more probably on the US side than you would here in Canada. So, you know, the Midwest is probably where you want to be these days because you get it doesn't appreciate as much as maybe the coastal states, but certainly, you know, certainly you'll get a steady cash flow, and you'll have a tenant base that are not leaving essentially. So, unless we have a sizable correction in Canada, you know, you want to be where you're making money on a monthly basis essentially.
So AJ is asking me, do you have to set up a separate LP in a US Corp for each property, or we can buy multiple under the same LP? So basically, the way we do it in the US is we do a lot of new construction from the ground up, and every project is treated as a separate LLC. So it's just a flow through entity where the money goes from the LLC to our C-Corps. But we kind of try to have that structure just for liability purposes. When you have 20, 30, 40 projects on the go, it just separates things and makes it a little bit more cleaner, and you're a little bit more protected. But it all depends on how you want to scale your business and how many you're doing. But, you know, I know people under the LPs, they'll have multiple properties. It's just a question of risk and having good advice on how you do your business. I don't know what you want to add to that, Elliot.
Yeah, no, you hit it on the nail, to be honest. And it really comes down to your risk threshold, and that's what I tell people. You know, I have clients that have one property, whether it's two or three units in one LP, and for some reason they want to set up more. You know, and I have some clients that have 40 or 50 properties in one LP. You know, end of the day, if you're refinancing the properties, kind of 2 or 3 every 4 years, give or take, you're taking the equity out of the property, so your risk threshold kind of diminishes because you're taking your original investments out, right? So it's really going to come down to kind of your risk threshold, whether you want to have 2 or 3 properties in one LP, or whether you want to have, you know, only one. You know, I've spoken to a few attorneys on this. They typically recommend, again, I'm not an attorney, but they typically recommend somewhere in the 250 to 500,000 equity range of before you want to set up a second one. But again, it's your risk threshold. If you want $100,000 equity in a couple of properties before you set up a second one, then that's up to you. But it's going to be dependent on the individual as opposed to the actual amount of properties you have. So.
All right, next question. Shanja asked, I missed the answer to this question. If you could just go over it again quickly, what type of entities would the dummy US Corp in the organization chart example?
So in theory, it could be 2. I probably prefer a C Corp, but you know, and a C Corp for is really just any type of corporation in the United States. I mean, 99% of corporations are C Corps in the US, but you know, it can be an LLC that's taxed as a C Corp. So it's basically, it's an LLC entity, but in the US you can tax it differently. But typically, you know, from a Canadian perspective, I prefer a C Corp, but yeah, we can work with LLCs or some type of other entity.
So Natalie asked, we haven't heard that it's possible to have a C Corp held by a Canadian holdco to purchase US real estate. Does this still pose any of the same issues of owning a C Corp outright? So to answer that question, that's kind of the way we're structured, Natalie. We have a whole bunch of different corporations, but at the end of the day, we have a Canadian corporation that's holding all our assets in a C Corp in the US with basically a spider web full of LLCs under that.
So you need to, so in theory, it's going to be dependent also on what type of properties you buy. If you're buying primarily for long-term holds, for rental purposes, the income you're earning in the US is going to be considered what's known as passive in nature. So then your Canadian corporation would be subject to the FAPI rules that we talked about earlier, where, you know, that Canadian corporation owns a US corporation that's generating passive income, right? So, you know, in that case, the FAPI rules might be triggered, and yes, the Canadian corporation may have to include that income on the US side every year. What Mathieu does, he essentially builds from the ground up. So they're not really holding property long term. They're building, they're developing, and they're reselling. That's not considered passive income in the US. It's considered ordinary income, right? They're doing this as a regular job. So it's a different type of vehicle. That's kind of why Matt has the Canadian corporation with the US entities underneath it. But that's why it's going to be dependent on the type of properties you have and what your goals are, and determine. You know, that's kind of why I prefer more of an LP type structure. But again, it's going to be dependent on the type of properties you're buying and what your plans are. So
Jeremy Hill is asking, how many properties do you recommend holding under one LP is in respect to liability protection? We kind of answered that.
It's like just to touch base again, it's really just a risk threshold. You know, I have clients with one property, I have clients with 20. So you know, you're gonna have to figure out how much equity you want to expose essentially before you kind of set up a second one and third one. So
Peter's asking, that's the pros and cons of using active C Corp to hold the US investment property. Example, depreciation, offset, deferral, retained earnings, dividend, and all that.
So can you repeat that? I'm not sure I fully understood that.
So the pros and cons of using an active C Corp to hold US investment properties, like depreciation, offset, deferral, or retained earning and dividend.
Yeah, so if you own real property, regardless of how you own it, essentially, whether it's through an LP, a corporation, your personal name, you are eligible to claim that depreciation. Obviously gets filed on a separate form, depending on how it's held, but at the end of the day, you are eligible to claim it because you're earning income with respect to that property, right? So the depreciation you're eligible for, you know, the utilities, you know, any administrative costs, possibly some travel costs if you go down to see it and want to buy more. So at the end of the day, kind of the golden rule when thinking about these sorts of things is that if you have an asset that's producing income, typically the expenses associated with that is deductible, regardless of kind of how you own it, essentially. So.
Sean's asking, what if you're only wholesaling real estate in the US as a Canadian? Which entity do you recommend for setup, as they are tax and legal liabilities to do this?
Yeah, I mean, it's going to be dependent on your personal situation, but like I said, typically some type of partnership makes sense because it's one of the few flow through attributes that CRA kind of recognizes as a Canadian. So, you know, there are options for you, whether you want to set up a trust or you know, whether you want to do it through a corporation. But again, it's going to be dependent on your individual essentially guidelines and goals that you're looking to do. But 9 times out of 10, if you kind of make under $200,000, a lot of times an LP is probably the most beneficial type structure for you. So,
and I think the last question I have right now is, does the C Corp LP need to be in the same state of the property?
No. So typically the C-Corp, that 1% general partner, I would probably recommend like a Delaware or Wyoming corporation. Because if you do choose in the future to buy property in a different state, then you can still use that Delaware corporation to be that 1% partner. So typically that C-Corp will be a Delaware formed corporation, and the LP that owns the properties would be formed in the state that you're buying in. So.
Does anybody have any questions they want to hop on before we sign off?
I have a question that was missed here. This is Aldo. The question is for Elliott. So the question is regarding the organization chart that you showed before in your presentation. There's a dummy U.S. Corp that you set up. So what type of entity would that Corp be? Is that an S Corp or what?
So it would probably be a C-Corp. That's what I typically recommend. So S-Corps are only eligible for U.S. individuals. So Canadians are not actually allowed to open up an S-Corp. But yes, it would probably be a C-Corp, likely formed in Delaware or possibly Wyoming or Nevada if need be. So.
I see. Okay. Yeah. Thank you.
Anybody else have some questions before we sign off?
Yes, just backpack to that question. That dummy corp, can that be a LLC?
It can, yeah. So I mean, I do have clients that have LLCs as the 1% general partner. Typically, what I do is I recommend to elect to treat that LLC as a corporation. So in the U.S., an LLC is essentially, if there's only one owner, it's considered a flow-through entity for U.S. purposes. If there's multiple owners, it's considered a partnership. Or you'll have a third option, essentially, to treat it as a corporation. So it's kind of a tricky situation, but that LLC does have the ability to be treated. You basically file an 8832 form, entity classification form, that treats it as a corporation going forward. So
if let's say you own something right now in your LLC, is there any possible way to swap it out to make that LLC as a dummy corp?
Yeah, absolutely. So you can quit claim deed, that property into another entity, whether it's an LP or whatever the case may be. But yes, I mean, you can essentially convert, or you know what else you can do? You can also do an entity classification for that LLC and convert it into an LP. So there are options, absolutely. You'll need a local attorney to do quit claim deed of the property from the LLC to the new LP. And then yeah, you can use that LLC as a dummy corporation essentially moving forward. So
great, thank you.
1 second here. Couple more questions came in. If I already have a C Corp LLC structure, does it make sense to switch to an LP? And is it possible? We kind of just answered that.
Yeah.
Just saying on the chart example, is there another 99% owner of the LP held in a personal name or a Canadian corporation?
So that 99% partner can essentially be anybody. It can be you, can be your spouse. You can split it up amongst your spouse. Again, depending on, we have some people with, a married couple might have a higher income than their spouse. So it might reach some tax opportunities there. It can be one of your corporations that you have here in Canada. Absolutely. It is typically, I try to avoid having passive income through Canadian corporations because it is taxed at about 50 to 53% here in Canada. But again, if you're making more than $200,000, then yes, you might want to keep the funds through the corporation and make the investment. That 99% investor can be the Canadian Corp. So,
any more questions before?
One quick question.
Yeah.
Hey, Matthew. Hey, Elliott. Thank you so much for today. Having a quick question, Elliott. So for example, I set up an entity in Ohio State because that was the state that I originally was looking to do business with. But since now I'm looking at Georgia, you mentioned that at the beginning that you typically recommend to establish the entity in the state that you're going to do business. What are the cons or the things that I need to be aware of if I'm going to buy a property in Georgia with Ohio State going forward?
So you're gonna have to reach out to the Georgia State Department for one. Actually, I should say the Ohio Department for one, just to see if you can purchase property there. In theory, you probably can. You'll have to register that Ohio LP in the state of Georgia to indicate that you're not doing business there. But at the end of the day, I mean, the reason I kind of recommend buying in the same state you set up is because there's additional tax filings you have to do for various jurisdictions. So that Ohio LP not only has to file a Georgia return for for the property that it purchased, but it also likely has to file an Ohio partnership return as well because it's informed in that state. So it just kind of adds to the tax filings at the end of the year and it adds to the cost. But most of the time you should be able to buy Georgia property through that Ohio LP. So.
Okay, I just have to register that in advance with the Georgia state, right? Okay.
You should, yeah, absolutely. Yeah.
Okay, thank you very much.
Yeah.
There's another one that just came in, a new question there before we just log off. Can you explain again the point of setting up the dummy corp and the C Corp?
Yeah, so the main reason with respect to a partnership, you need to have two partners, right? So, if you in theory, it can be two spouses and you can have 50-50 ownership. The problem with the LP structure is that one partner has to be a general partner. And from a liability perspective, the general partner kind of takes on that risk with respect to, any losses that might occur. So if a tenant sues the general partner, not only can go after what they contributed into the business, but they could also go after the personal assets for that general partner. So we kind of set up that dummy corporation to be a 1% partner where, it really holds no assets. So in theory, a tenant can sue that general partner for their personal assets, but they have nothing to sue for. So it's basically just an added layer of protection from a liability perspective. And to be honest, it's really disincentivize their tenant's ability to kind of sue the landlord essentially. So.
And another thing too, before we end this, if you guys, I'll be emailing everybody the recording in the next 2-3 days. But if you guys want, I'm going to start bringing in more professionals, Canadian guys or Americans that do business with Canadians, just to kind of make it a little bit more transparent and make it a little bit easier as Canadians to invest in real estate, because it's, like I said, the information is not as available as investing in Canada. But I was thinking maybe of doing the next one, having a security lawyer from Canada talk about about investing and doing different things in the US. Like we're setting up an investment fund with this particular lawyer. So I might bring him on if you guys want to do that. But if you guys have any suggestions, please feel free to reach out to myself or Elliot, and we'll have something else like this. All right, one last question before we log off. Is it preferable and cost effective from a tax position to set up many LPs, as many properties as you want to buy in each state?
Yeah, so you're gonna have to figure out what type of properties you're buying. If you're buying small single families, I probably wouldn't set up one LP for each single family. If you're buying a 20-unit building, for $1 million or $2 million, then yeah, you might want to segregate those assets between the other assets you own. But again, it's gonna come down to your risk threshold and the type of properties you're buying, because every LP you set up, there is additional tax filings and incorporation filings that need to be done on a yearly basis. So, so at the end of the day, I mean, you're gonna have to figure out the cost benefit between opening up multiple LPs. So.
Sorry, I have one more question.
Sure.
Just back to the dummy corp again. So do you, like, let's say you have some long-term hold there, you are renting out some space, some spaces. So is that the landlord would be the dummy corp who's signing the lease?
So you mean signing the lease? Like the essentially the LP, because they own the property, would be signing, or sorry, the general partner, correct. The dummy corp would be signing the lease on behalf of the LP essentially, because they're kind of managing the day-to-day stuff essentially. So. Okay,
so that's why if anything goes wrong, since there's nothing in it, then you protect yourself, and then if anything else goes through, then 99% of the profit flows through back to Canada.
Absolutely, that's exactly it, right? And it's more from a legal perspective. There's really no incentive for a tenant to sue the landlord, or at least sue the landlord for for their personal assets, and that's a difference, right? So because there's really nothing there in the dummy corporation that they own. So.
Thanks for clarifying it.
All right, guys. Well, thanks again for coming on today, and I'll email everybody the recording, and I'll have hopefully a guest speaker plan in around 2-3 weeks. I'm not too sure if you guys like that on a Saturday, something different. Usually I do it on the evening, but I wanted to do something a little bit different. But if you guys have any suggestion, again, feel free to reach out to myself or Elliot. But have yourself a great weekend. And again, thanks for logging in today.
Thank you, Mathieu. Thank you, Elliot.
Thanks, guys.
Bye, guys.